Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Rob Prugue, Principal Consultant at Callidum Investment Research. Many of you probably know Rob from his 30 years of background in superannuation and asset management in Australia. Rob, welcome.
Hi, Alex.
Well, I thought today, what a great place to kick off the conversation where we have, again, more irrational exuberance in the markets. We've done some research in Investment Magazine around Robinhood traders and day traders getting all excited and pushing the markets back and forth. Sort of wanted to get your perspective on what you're seeing today and maybe in the history of what you've seen more globally in terms of these sorts of exuberance that we see.
Sure. I guess there's really two angles that I would address it at. The first is the personal self-belief, and the second is more of an agency issue. With regards to the first, I remember when Schiller's book, Irrational Exuberance, came out, and it caused me to reflect over my career, I guess. And I remember how ego, coupled with maybe how that ego was consumed, blinded people to this sort of self-level of comfort or false comfort. And sometimes that was expressed by their consumption and other times by the way they actually built portfolios. I remember the 1987 crash and preceding the 1987 crash, how people were spending money stupidly. And some of these portfolios, again, looked rather odd. Then, of course, I remember the Asian financial crisis, where I was a young analyst and I was in Singapore and talking to some of these Asian PMs and what they were doing and how they were constructing portfolio. And again, this sort of self-belief that there's someone else behind them who will continue to push the price up. Then, of course, the dot-com, whereby even the greats of Warren Buffett were tainted as brick investors. And when I say brick, I'm not referring to the emerging market, but old school, brick and mortar, and how they were lagging behind. And again, the consequences therein. And more recently is, I guess, a QE-induced don't bet against the Fed mentality, whereby it seems to show that any correction tends to be short-lived. So in previous corrections early on, any correction would have been L-shaped, a very rapid decline followed by a very slow resurgence. More recently, as was seen during the first Trump when he won the election, coupled later, of course, with the Brexit, you saw a rapid correction, but once the dust settled, and the abundance of QE money floating, again, the don't bet against the Fed mentality took over, and the correction was just as steep. And you see a bit of that now, whereby the market had retraced much of its early falls post-COVID, only recently, of course, coming down a second wave following the fears of a second wave of COVID infections. So this don't bet against the Fed, my concern is that it's causing sensible people to embrace unsensible risk. And again, history has shown them right, but eventually something's got to give. And I have no clue what that is or when that's going to be, but I'm rather confident that eventually the dust will settle, and even no amount of QE will be able to sustain some of the irrational behaviors, be it professional in construction of fund or an irrational belief that you don't bet against the Fed, and at the end of the day, the Fed will always bail you out. That's a rather dangerous one, and we've seen this before, whether it's the Fed or the RBA through monetary policy or the government through bailouts. But somehow we've appeared to have morphed into a new environment whereby profits are privatized, but losses are socialized. And so even if the Fed doesn't bail you out per se, the government will. And the dilemma here with regards to superannuation is that one would assume that defined contribution funds, as of course we embrace, the concept of caveat emptor, buyer beware, is supposed to hold. So even though it's nationalized savings to offset future tax burdens, and we incentivize those savings through tax management, would any government allow a large superannuation to go belly up? I sincerely doubt that. I can't really think of one Western nation, democratic nation, that would allow 300 to 400,000 people go broke and see their superannuation wither into nothing. So if this irrational behavior of the Fed always bails you out and the government always bails you out, does that actually conflict with this concept of caveat emptor embedded within defined contribution? Have we really been managing in the last 5-10 years, have we really been managing a wealth management business as opposed to a retirement business? If it's a retirement business, then our goals should be CPI plus. But the reality is the goals for many CIOs and the incentivization of many CIOs is ranking. There's a disconnect here. So heads I win, tails you lose is a rather hard thing to overcome in this world of, dare I say, irrational exuberance. And so at the beginning, I said the construction of a portfolio followed by the agency of the portfolio. Again, this sort of where do I rank? And the agency component is a financial incentive. And, as Tom Peters once said, that which gets measured gets managed. And whether it's the heat maps, whether it's the league tables or the ratings, we tend to favor those funds who have done well over a 1 or 3 year period. Mm-hmm. And we tend to reward them. We reward them with positive ratings, and when the positive ratings comes, what do you think happens to their compensation of the investment team? It goes up. So the agency question in this irrational exuberance is, are we shooting at the wrong goalpost? And so
it's interesting.
It really is a very broad. So your question is a really broad one, but in my opinion, you need to break it down into construction phase and agency phase. So because both are very strong influence.
Let's do that, right? So let's just go back to a couple of things you mentioned there, which is sort of this jawboning of markets, the central banks supposedly having your back, the idea that Warren Buffett, some laggard, has got no idea what's happening in markets. We've actually seen that again, with these Robin Hood traders. We've had this new guy, David Portnoy, this internet celebrity of Barstool Sports, who's this new head guy of Robin Hood trading. And, he's made comments like, it ain't bragging if you ain't backing it up. And it's just got, for me, it looks like it's got to the extreme again of the 2000 .com boom days where, he's also criticized Buffett. And, Buffett sold out all of his airport stocks or airline stocks, and this guy's now gone in and gone crazy. So you've got this backdrop where it feels like you just can't lose. So if I take that small anecdote and sort of amplify that to some of the superannuation funds, are they also now in sort of, almost damned if they do, damned if they don't, need to go down this path and just keep investing for growth because they need to keep hitting performance targets. They need to keep up with their competitors in terms of these league tables. And maybe they don't believe in markets continually going up, but they've got no other option.
Yeah, I think you're right. I think it's, again, going back to what I said on the agency issue, is and how people are compensated. I don't doubt the integrity, what 1 inch of the investment people, whether inside the superannuation or the manufacturing. I know that they understand the semantics, and they clearly understand that however you value it, things look expensive. The challenge, though, is not that things look expensive. The challenge is, where the hell do you invest it? If you presuppose that all assets fall back on cost of capital as their pricing mechanism, as the foundation of the pricing mechanism, and when the cost of capital is negative in real terms and next to negative in nominal terms, then where are you going to invest? Bonds? And so what you're finding now is you're finding increasingly the marketing of unique ideas. And some of these unique ideas are packaged by external fund managers, and some of them are created internally by some investment teams within superannuation. But the question still goes back to the goal of superannuation, CPI plus. Are the investors embracing an unrealistic level of risk in order to, one, separate themselves from the pack with the hope of trying to have one of those be a real winner? Private equity, when I started in the industry in the late 80s, it was difficult to find any financial literature that was supporting and positive on private equity. I remember some of the studies that I read showing the track record over the 60s, 70s, and 80s. And it was really sporadic. You had one good year out of 5 or something like that. So meaning out of the 5-year holding period, only 1 year of it you really made any money. The other years you were losing money. And so when you extended it, the rate of return wasn't that great. Now, of course, that doesn't seem to be happening. And because it's not liquid and it's not visibly priced, it's given people some false sense of assurance. Add on top of that, how some superannuation funds, are remunerating their CIOs based on the overall volatility of the fund. Are funds embracing an unrealistic level of risk in order to achieve a different objective? Not the objective immunization of CPI plus, but again, to what you said, is there's enough sources out there to bail them out, coupled with the fact that if they get it right, their compensation is going to be very handsome.
And if they get it wrong, it doesn't seem to matter.
If you get it wrong, well, okay, you're out of a job, but at least the RBA or the Australian government will bail out the super fund. When the previous liquidity issues that we had some years back, what saved that fund was other funds coming together and buying these illiquid assets. That worked when funds were relatively small. There was no major behemoth. But now with the regulators and the government enticing and pushing towards fewer number to be bigger, the consequences of one of these funds getting it wrong in a defined contribution caveat emptor is huge. And so I've been very vocal in as much saying, fine, you want to be bigger, that's great, but why? If you can't answer why you want to be bigger outside of agency-driven reasons, why, as a member, do I want to be large?
Mm-hmm. It's interesting you say that about sort of why do you want to be large. I had an interview just recently with Graham Russell, the outgoing CEO of Media Super, and he made some very strong comments around sort of the benefits of being small, the benefits of being nimble, the benefits of being small enough to understand your members and actually also invest in your industry group, that you represent. What are your thoughts on sort of some of these smaller funds operating? And the other claim, I guess, with the size is that they don't seem to have the benefits of scale. But does it really matter? Do you need to have these benefits of scale?
Well, if you look at some of the large sovereign wealth funds, and I'm not talking future fund, I'm talking larger funds than that in Europe and let alone Asia, they would flag the diseconomies of scale, meaning that they're so large that there could be an arbitrage opportunity in microcap, but they can't participate because they're just too large. Firstly, the larger you are, the more difficult it becomes to arbitrage the inefficiency of a strategy. Also, coupled with the fact of the QE and the large flows of money, the beta arbitrage or the market arbitrage is pretty much non-existent. It's just going with the flow, the inefficiencies. So you have to find sub-sectors and sub-markets within a broader market to find where the efficiencies may lie. Could be bank loans versus corporate debt, as an example. Or it could be a certain real estate tranche versus all overall commercial real estate. Mm-hmm. But this economies of scale is again the challenge. Now, I would recommend all everyone working in superannuation, particularly industry funds, to reread your reports, your annual reports, and the documents you send, and show me where it says we are pursuing economies of scale to make more alpha. It's not going to be in there. More often than not, this issue of economies of scale, I think, has surpassed this issue of trying to find something cheaper, to differentiating ourselves and being the big behemoth that people naturally want to come to us. Now, anyone who has done CFA level 1 knows of Michael Porter. And Porter analysis basically says if you're going to run a strategy, there's only really 2 strategies to run. Strategy number 1 is to be the biggest, where you do get economies of scale. And you can survive, but you have to be the biggest. Strategy number 2 is you have to differentiate. You have to be unique. Your offering has to be unique. If you're a medium-sized manager or super fund and you're not employing one of these 2, you're going to lose. The market will overwhelm you. So if we look at superannuation, there's a lot of medium-sized funds whose ambition is to be in the top 5. The question I would say is, okay, what is it going to cost you? What new risks will you be embracing that you currently don't embrace? And are you able to manage those risks? It's these questions, or the lack thereof, is what concerns me. There's sort of drinking the Kool-Aid and presupposing that bigger is better no matter what. If you're pursuing bigger and better, you better do it for a cause and be able to show that that cause is going to benefit the members. Because in essence, your members are subsidizing your marketing, and they're subsidizing through some of the investments that they ontake as these funds grow, and they ontake other DB plans and DC funds. They're taking the valuations as in the ledgers of these other funds, which haven't necessarily been stress tested. And so the members are subsidizing the management's ambition to be large. So there too, I think there's a level of governance to oversee this required. How is it doing? What's the members? What are they funding? Are they aware of that funding? And the best example I can give you was when I was at New South Wales State Super, and the then treasurer Michael Egan decided to sell State Super to Morgan Grenfell, and of course later becoming Deutsche. What they did, the government did, is they hired an investment bank, but they also hired Mercer's. And Mercer's objective was purely to make sure that the members weren't going to take on any unnecessary risk in order for the government to offload this investment. And I think the same thing could be said here within superannuation. You want to internalize? Fine. Who's representing the member? Now, the clear answer, of course, is the board. But all too often, the board, with a great amount of respect, either doesn't have the gravitas to challenge management on some of these risks that they undertake, or two, they embrace the theory and they're letting their colleagues getting on with it. That is how disasters happen. Not out of some sort of corruption, not out of some sort of malfeasance, but rather a false sense of security that we're doing the right thing because you haven't challenged that view.
Mm-hmm. Let's maybe take it from that sort of view that you've just described. You know, if you were thinking about, you know, a smaller fund, maybe in the $5 billion mark, even up to sort of the 20, 30 billion, if you were sort of sitting in a fund and you're a CIO of one of these funds, you know, how would you prepare the portfolio and then the various systems and governance that you want around you that's constantly challenging your thinking to make sure that you're actually taking into consideration these risks that you've just described?
Well, many of these smaller funds have an advantage that the bigger funds no longer have, and that is better engagement. Why? That's not to say that obviously the big super funds don't have engagement with their members, but the level of engagement is next to impossible to replicate a fund with, let's say, 20,000 members or 100,000 members to one of 500 or 800,000 members. So as they grow larger, as they are accepting more and more members, in order to retain that level of engagement, the staff personnel required would be prohibitive. And so, you know, this is what I was saying, you know, with the heat maps. There's nothing in the heat map which is consistent with the actually derived portfolio immunization. It's only risk and return. It's not, well, how does that fit into, nonetheless, into the level of risk that was undertaken to grab that return? And how did that return contribute overall to the fund's long-term objective? We don't have that. And so smaller funds, because of the argument I said before of diseconomy, at a certain point, diseconomy kicks in, have that advantage. But where the true advantage, I would argue, that many smaller funds have, that perhaps they're not extracting well enough because they too are worried about being swallowed up by the quote unquote big boys. They're losing that, you know, they have something that the large funds will never have. And that is, of course, a better engagement. And then they're saying to me, yeah, but the government's kind of pushing me to merge. And it says, well, they can't force you to merge. Deliver what you're going to deliver. And you know what? Confront them. Say, I think you're wrong. Show me in my IMA, any page in my IMA that I'm not fulfilling. And then let's talk about it. But to push me to be larger for no other reason than to be larger, because some sort of belief that bigger is better, I would argue you are the one who is at fault here of the future disaster, not me.
I'm curious.
And I don't think there's enough of that challenge.
It's interesting when you say that sort of this challenge, because I actually sort of think about it that the problem is also an equation problem to solve, because the whole premise with these league tables is really for funds to solve for a maximum return, without really much control around risk. Like let's be honest there. So in one case, you're trying to solve for this return, a max return, with risk sort of seen to be sort of agnostic, versus a CPI plus target, which is what you say it should be, right? And what a lot of them are also putting in their PDS documents and so forth, right? Shouldn't they be solving for a CPI plus 3 or CPI plus 4, and they solve it for the best, return, or they hit that return with the lowest amount of risk? Isn't that really what investors are looking for? Hitting a particular CPI plus target, it's consistent through time, and they minimize risk. It seems like we've got the equation, what we're trying to solve for, completely incorrect.
I think so. But then again, maybe you and I are singing from our own hymn book, and I accept that. But I constantly challenge that myself and say, what am I missing? Because this is going on for a long time, and it hasn't really, I guess, been challenged enough that people are coming around. And the only answer I can give is it's funny how there's no league table for DB funds.
Yeah.
It's funny how there's no league table for variable annuities funds. But there is a league table for DC. Why? Is a DB and a DC, as Keith Ambeck used to say, the only thing that separates a DB and a DC is where it sits on the who owns the liability. They're both pension funds. So why is it that these league tables and these agency issues are more prominent in our system than in other countries that has more DB or PAYG or variable annuity? And that is my other beef. My other beef is, as I said before, on caveat emptor. It's almost like these league tables and heat maps are encouraging and promoting this irrational exuberance and irrational behavior, forcing funds to embrace levels of risk that no DB fund or variable annuity would ever do. And if that's true, then do us all a favor. Get rid of the tax incentive. Don't let the taxpayers subsidize the saving schemes so we can create a wealth management business.
Yeah. It's an interesting one because there is a lot of support. It's not even the tax incentive, but there's also the superannuation guarantee, that money keeps coming in. And it keeps pumping this sort of game, if you want to call it something like that, because that's what it feels like today. The whole. Oh, should I go?
Well, again, if we go back to when superannuation was introduced and how it was 50% coming out of the member, the employee, and 50% of the employer, it doesn't really matter. That's the member's money. I mean, if you recall why Keating introduced it, we obviously to offset the future tax liabilities, but he did it in a way that the cost was borne by both employee and employer, but the total cost of employment was still the same. Mm-hmm. So at the end of the day, that means that the member, it's ultimately the member's money that's going in and forcing them to save it. And it's going into this wealth management outcome because of the way we're rating and rewarding funds who are successful, because the goalpost at which we're aiming for is the wrong one. It's a wealth management, which is totally fine. The wealth management business, as we all know, is large enough as it is. But the big difference is wealth management doesn't have tax incentives and tax subsidies as superannuation does.
You could also say that some of the wealth management business has a much more ruthless governance structure that sits beside, alongside it, in terms of if you don't perform and your products aren't delivering, then you can be cut quite quickly. But you don't seem to see that in the superannuation space. Is that a fair assumption?
No, you're seeing it more and more in the superannuation as well. I mean, ask any CIO that's lagging the league tables. Mm-hmm. It's funny, when Q Super and AMP and others were starting to build target-based funds of CPI plus, and they extracted themselves from the league tables. At the time they did it, everyone was nodding their head. Yes, this makes total sense. Yes, absolutely. And then a bull market came soon thereafter, and these funds were doing everything they meant to be doing. It's just that they weren't delivering 15% returns, because, of course, that's not a pension objective. And so they suffered. So, there were people were pulling their money out. Even funds that aren't open to outside members face that same dilemma. Not because they need to be competitive in league tables to attract new members, but to retain existing members. And this is, again, where the wealth management marketing verbiage comes into play. The best example of the marketing verbiage that I see in superannuation is, more often than not, the ads are of people surfing while retired, or in their yachts, and they're financially well off, and that's not true. We're not saving enough. The average Australian will never have saved enough to live that kind of idyllic life where they have a yacht and they're traveling to Europe twice a year. And it's like I said, Google retire rich, and then look at the images of all the magazines and all that, and you'll see that. You'll see this sort of retire rich of the person being under 65, clearly being wealthy because they're on their yacht or they're in a pool in some exotic resort, which of course is just this sort of marketing agency driven issue. Because if we look at what pension is, we don't see the same thing with variable annuity funds or DB plans.
Mm-hmm. Well, they're not trying to sell the lifestyle. See, that's I think the difference. The other one sort of there's a set amount of money here that's going to be paid to you. The DC plans are there to sort of sell this almost get rich quick style, mentality where you can have a big pool of money at the end that becomes this retirement pot. So keep that thought about, again, selling the lifestyle and selling it. And again, we're breaking away from that CPI plus 3 objective. We're breaking away from the annuity stream that pensions is meant to give away. We're breaking away from the dull nature of what pensions really are. Mm-hmm. And we're glorifying it into some sort of Gordon Gekko wannabe, whereby if something goes wrong, it's all right, I'll get bailed out. Someone's going to bail me out. Or the Fed's going to come in and pump more money into the market, and it'll revert, and the recovery will be quick and V-shaped. It's a super challenge when you've got this situation, because if you in the back of your mind always believe that the central bank will be there to have your back, interest rates never go up, right? And you've got nobody across your board, your investment committee, that is really willing to speak out, or if they do, maybe they're just that lone voice. Yeah, what do you do?
Well, you touched on the board, and I guess another thing I would sort of discuss on that is the diversity of the board. More often than not, people reflect diversity of boards by gender. I'm not sure it is just gender. Diversity, in my definition, is diversity of thought. And diversity of thought comes not just in grabbing people from different backgrounds, so someone can talk legal and someone can talk investments and someone can talk, but also diversity of thought, someone who didn't go to Sydney Uni or Melbourne Uni, but actually maybe went to IIT in India or Harvard or whatever, another really good university in another country. The diversity of thought comes in different shades, in different genders, and in different financial brackets.
Can we extend that to actually people in different countries potentially? Because if you think about superannuation, and particularly that it's investing more and more internationally, should there be now more of a requirement for some of these people to actually sit outside the country?
Well, I've researched many companies, big companies, where they have diversity by countries, and I'm not sure the logistics of that, given that, of course, we are an Antipodean island, that we can truly get that, because, again, most proper board meetings will be all day, and the cost of flying the person if you can get them out, et cetera, et cetera. I don't know. I think one thing that Australia is very good at is that they have a very, relative to many other first world nations, we have a very strong international openness. We are much more internationally aware than I would argue, than the average North American or even European. I know that's a big statement, but I think that is because we are in the far reach of the world. So we have to be. I think that's one of the reasons why Australia is one of the early adapters to new ideas. I remember when I started at AMP back in the late 80s, we used to get the shops like Salomon Brothers, Goldman Sachs, Morgan Stanley, Fisher Black. I mean, some really amazing people coming out. And they always used to say to us, maybe they were just pissing in our pocket, but they always used to say to us, yeah, we're blown away how well informed the Australian market is. Because we don't get that same diversity of information in many of our own North American clients. So to answer your point, I think the diversity question, the main point of that is that it's not just a gender-related question. It's a diversity of thought. And it is possible to have the same thought by different genders, by different races. And so if the goal is to diversify the boards, then the question should be, how are these people diversifying? And hire everyone from the same golf club is not diversification. And you and I both know as well, some funds basically are hiring other board members of other funds. That's not diversity.
Mm-hmm. Let's take it back, final question, but take it back sort of where we sort of started in terms of this irrational exuberance that's going on, and sort of rethink that, with this COVID crisis, we are starting to see some evidence of a secular change. But I haven't seen much, in terms of a difference in the way that funds and fiduciaries are thinking new strategies to perform, in this new environment. How do you get them to change? And what needs to maybe happen for people to actually realize that there is a change coming?
Well, it's interesting. I over the last few weeks, and speaking to many friends in the industry, they all say the same thing. They said, my God, I've never worked this hard before COVID. And so I have like 60 hours of Zoom meetings and what have you. And I think everyone is trying to focus their attention on where COVIDnomics, lack of a better word, will push us towards. What will be the consequence of it? And so therefore they're preparing themselves for a more volatile world, or they're preparing themselves for a regionalization, from a move from globalization to regionalization, all these theories that are going about. What I've sort of taken a step back is, are you getting false comfort from trying to read your tea leaves? Because no one knows where we're going to end up. So if that's true, then would our time not be better spent by focusing, are we ready to adapt to a changed environment? Or are we still embracing some of the old, outdated tools and systems that will make our adapting to a new environment that much harder? And let me give you one example. There's dozens I can give you, but let me just give you one. Where a medium-sized super fund, they have a CIO. And the CIO has a few people around them to work with them, et cetera, et cetera. Now, this super fund is divided between a board and investment committee. Again, if you look at the organizational structure of this super fund, it'll be hard-pressed to differentiate it from any other super fund, with the possible exception that they don't internalize. But everything else pretty much looks the same. So when I was talking to the chair of the IC, I said, well, don't you guys meet 4 times a year? Yes, he responds. And is it not true that during these 4 yearly meetings, that's when you decide and make and implement the recommendations by the CIO? And they say, yes. Well, there you go. You're going to find it harder to adapt. And he goes, all right, what do you mean by that? He says, well, look at the board at GM. Do you really think that they get involved in deciding how many blue cars or how many 4-door cars to make? Of course they don't. What they do, however, is they set a framework, guidelines. This is where we want to be in 5 years' time. We want the cars to be more efficient, 20% more efficient. We want to have all electric cars in 20 years' time. Now, within these parameters, we want you to get there. And so what I was saying to this fund is, as I said earlier, the L-shaped recovery is long gone because of again, don't bet against the Fed, the QE 55, whatever number we're at right now. Has meant that the recoveries are more V-shaped than L-shaped. And so by the time you decide to do something, you want to execute something that's been researched 2 months ago, you're too late. The market has already repriced it. And so wouldn't you be better off, given that you've spent members' money on bringing the CIO, to give guidelines to the CIO and then say, this is what we want you to do? And the question you should be asking your CIO is, given the guidelines, is there any reason why you don't think you'll be able to reach your objective? Is there some impediment that will block you from adapting and moving within the guidelines? That, to me, is a more realistic question, because at least I'm better able to identify that's what's wrong within me than trying to pontificate where the market's going to go.
It makes a lot of sense, and it's also the reason why I think you see some CIOs have chosen to allocate money to these multi-asset style products, because they recognize the difficulty of being able to move, and the structure that they have, and so this is a way that they can feel they can still get access to good managers that can hopefully be dynamic in their approach to markets and these fast moving situations that you just described.
But the other example I give of this agency issue and how it fits in is right before the dot-com crash. You may remember Boots PLC story. And Boots PLC, of course, the big pharmacy company from Europe, UK, excuse me. And they had a large, granted, it was a DB plan, okay?
Mm-hmm.
Therefore, it had a very rigid, CPI plus 3 target. Anyway, I guess about 3 months before the correction, having participated in a very strong bull market, the fund was fully funded plus 10%,
Mm-hmm.
10% cushion. And so a couple of months before the correction, the CIO of Boots sold all the assets and moved it, a very large fund, mind you, and bought inflation index gilts, which at the time were yielding CPI plus 4. So he sold everything, sold out of property, sold out of liquid assets, whatever, and bought CPI plus. And he staggered it. So 5 years, 10 years, 30. And of course, in the UK, you can even go up to 100 years in some of these gilts. And so he was able to basically immunize a portfolio and the surplus, no problem. The correction hit. And of course, he was getting calls from everyone. How did you know the market was going to correct? My God, you're a guru. And he said, stop. I'm not a guru. I was just managing to my objective. Yes, I thought the market was overvalued, but when the bond market was offering me CPI plus 4, how daft would I be not to grab it? And again, this is the issue: is whether it's agency driven by league tables, we're kicking the wrong goalposts.
Yeah. It's a fantastic analogy to really where we are today and sort of this constant drive for returns versus what do we need and how much is enough. And in this case, you've given a clear example of someone managing to their target and realizing I don't need to take any additional risk. I've hit my target and I'm happy with that. Mm. All right, that's been
I used to say all the time to my friends in the industry how interesting it is that the way we manage our own personal portfolio differs from the way we manage the portfolio of others.
That's always something that comes back to my mind, and that comes back to the old premise of the skin in the game sort of approach and what would you expect, if you gave money to someone else or if you managed your own money. That's been a fantastic conversation today. Thank you very much for your time, Rob.
My pleasure. Thank you for the opportunity.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Conexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.